Hi everyone, welcome to my channel. Today we would be discussing the topic Uncovered Interest Rate Parity Condition. This is part of CFA Level 2 Economics, Chapter 1. What is Uncovered Interest Rate Parity Condition? As per Uncovered Interest Rate Parity Condition, the expected return on an unhedged, so uncovered means unhedged or uncovered foreign currency investment foreign currency investment should be equal to the return should equal the return on a comparable domestic investment or on a comparable domestic investment. Now what do we mean by that? Domestic investment, it means that uh, in the case of, if an investor invests in a foreign currency, the return that the investor gets from his investment should equal the return from a comparable domestic investment. It is similar to covered interest rate parity condition we discussed in the previous video. In covered interest rate parity condition also, the expected return in covered interest rate parity condition, the return on foreign currency investment should be equal to domestic currency investment return, because and since it is covered interest rate parity condition, the foreign currency investment is actually hedged, that is it will be equal because we have already hedged our investment. In the case of uncovered interest rate parity condition, we haven't hedged our foreign currency investment, that is we haven't already decided the rate at which we would be converting the foreign currency investment back to our domestic currency, but it is just an expectation that the return from a foreign currency investment should be equal to the return on a comparable domestic investment. Now an equation for uncovered interest rate parity condition would be, if I write an equation, the equation would be equal to the change in spot rate, it should be approximately equal to the interest rate differential between the foreign currency and domestic currency. This is approximate symbol. As per our curriculum, this is the equation that we would be using. It means that the change in spot market rate, it should be approximately equal to the interest rate differential between both the currencies. If I write it in terms of words, it is expected change in this part of the equation, it is expected change in the spot exchange rate, in the spot exchange rate over the investment horizon. It should be reflected by the it should be reflected by the interest rate by the interest rate differential. which is this part of the equation. So this is a very important equation, and the equation says that the expected change in spot exchange rate over the investment horizon, it should be equal to the interest rate differential of foreign currency and domestic currency. I had forgotten to return the expected symbol. So above the spot exchange rate differential, if I put an E, it means that it is expected spot exchange rate differential. Okay. Now, let us understand this with the help of an example. In our example, we have taken AUD to INR currency pair, and it is a Indian investor who would be making the investment decision in this case. So INR is the domestic currency, Indian rupee is the domestic currency, and AUD is the foreign currency. Australia's interest rate is given to be 5% and INR interest rate is given to be 3.5%. Using this, we have to derive uncovered interest rate parity condition, as well as understand what do we mean by it. So without wasting any time, I'll write down the equation. The equation was given to be the expected change in spot rate should be equal to the interest, should be approximately equal to, but as per curriculum we are going to, since it is approximately equal to, we are going to equate it using this equation itself. So the change in expected spot exchange rate should be equal to interest rate differential. This would be equal to 5%. This would be equal to, 1 minute, expected spot exchange rate differential between AUD INR, which would be equal to interest rate differential between AUD and interest rate differential between INR, and this is equal to 5% minus 3.5%, which would be equal to 1.5%. Now, what do we derive from this? What do we understand from this equation? In simple terms, this means that the yield spread between AUD and INR, this part of the equation, that is the yield spread between AUD and INR is equal to 1.5%. That is, AUD is offering 1.5% more interest rate. Now this will be, but this also means that the change in expected spot exchange rate is also 1.5%, right? It will, this side of the equation here, since it is positive, it will mean that, it will implicitly reflect that, implicitly reflect the expectation that domestic currency, because it is positive 1.5%, that domestic currency will strengthen then versus the foreign currency, that is uh, here INR. INR is the domestic currency and AUD is the foreign currency. AUD is offering more interest rate, but since using the equation, it means that if AUD is offering higher interest rate, over time INR, which is offering less interest rate, INR currency would strengthen. That is, INR would appreciate over time was by 1.5%. The exact difference in interest rate versus the foreign domestic currency will strengthen versus the foreign currency by 1.5%. This is what this equation means. Now, how will it help an investor? Now, why is this equation there and how will this equation help an investor? It means that uh, if both over time, if INR will strengthen, if the domestic currency will strengthen by the same amount of interest rate differential that AUD provides, it means that over time, a risk neutral investor would be would be indifferent to either of the investment. Risk neutral investor would be indifferent to either of the investment because both will give similar return, either of the investment, because since AUD is giving more interest rate, that is by 1.5%, in that case the other currency, that is domestic currency INR, would also be appreciating by 1.5% during that investment horizon. So by the time you will get AUD's return, when you convert it back to INR, you will get exactly the same return as if you had invested in a similar INR money market instrument. That's why a risk neutral investor would be indifferent to either of the investment. In other terms, the yield differential, the the risk neutral investor would be indifferent because the yield differential would be offset by the expected appreciation. The yield differential would, that is 1.5%, would be offset by the expected appreciation of domestic currency. In our case, domestic currency yield differential of 1.5% would be offset by the expected appreciation of domestic currency by 1.5%. So that's why risk neutral investor would be indifferent. Summarizing what we just understood, uncovered. Now I'll summarize what we just discussed. So uncovered interest rate, interest rate parity conditions assume, parity condition assume first, the currency with higher interest rate will depreciate. Currency with higher interest rate, currency with higher interest rate will depreciate will depreciate and this depreciation offsets the higher yield earned by the investor. This depreciation will offset the higher yield earned by the investor. Or in simple terms, in our example, INR had a lower interest rate, right? So INR would be appreciating by that interest rate differential that is equal to 1.5%. And that's why, since INR would be appreciating, uh, the higher the higher return earned by AUD investment will get offset by INR's appreciation by an approximately equal percentage. That's what uncovered interest rate parity condition assumes. But actually, in the real world scenario, does it exist? Usually, studies show that uh, depreciation of high yield currency do not occur in short or medium term. So studies show depreciation of high yield currency uh, usually do not occur in short or medium term. That is, uncovered interest rate parity condition usually does not hold in short or medium term, short and medium term, but this condition, that is uncovered interest rate parity interest rate parity works better in very long term horizon, very long term horizon. It is because if this condition holds true in short term and medium term, it means that an investor is not going to make any profit by uh, investing in other currencies based on the interest rate of that country. But that's actually not true, right? We have seen that in short term, we can make investors do make profit by investing in countries having higher interest rate. But as per uncovered interest rate parity condition, in very long term horizon, it shows that change in spot exchange rate will offset the will offset the higher interest rate offered by the by any currency. Okay. Now let us solve a question. In this question, they have said that the spot rate for AUD to CHF is equal to 1.7651. 1 year nominal interest rate is equal to 2% in Australia and 3.5% in Switzerland. Using uncovered interest rate parity condition, what is the expected AUD to Swiss franc spot rate in 1 year? Okay, so they have given us the current spot exchange rate. They have also given us the interest rate for both the currencies. We have to calculate the uncovered interest rate parity condition. As per our curriculum, we know the percentage change in expected spot rate is approximately equal to, but here we would be using the equal to sign because it is easier to calculate, and this is what our curriculum uses. So this would be equal to the interest rate differential between the foreign currency and domestic currency. Here CHF would be the domestic currency, AUD would be the foreign currency because our curriculum uses F by D notation, that is foreign to domestic currency notation. So AUD would be the foreign currency, CHF would be the domestic currency. So this would be equal to percentage change in expected spot exchange rate AUD to CHF would be equal to interest rate of AUD minus interest rate of CHF, which is given to be AUD's interest rate is 2%, Swiss franc is 3.5%. 2% minus 3.5%, which would be equal to minus 1.5%. Here the symbol is negative, it is negative, right? It means that here, if you look, Swiss franc has a higher interest rate, CHF has a higher interest rate. That's why it is coming to negative. The interest rate differential is negative 1.5%. It means that the change in spot exchange rate in that scenario, CHF is depreciating. Because CHF is having a higher interest rate, over the time horizon, CHF would be depreciating. The spot exchange rate of CHF would be depreciating. That's why negative symbol, minus 1.5%. Hence, the expected, hence the expected AUD to CHF AUD to CHF spot rate in 1 year would be equal to, in 1 year, it would be equal to, what is the current spot rate? The current spot rate is given to be 1.7651. So 1.7651 into the percentage change, but you have to add it to the, add a plus 1 to it. So plus, so 1 plus minus 1.5, change it back to decimal point. Okay, so this would be equal to 1.7651 into 1 plus, sorry, 1 minus 0.015, and this will come to be 1.7386. Hence, if you notice, the spot rate has decreased. The expected spot rate has decreased, that is, Swiss franc is depreciating. 1 CHF will now be equal to 1.7386 AUD in 1 year instead. So it is depreciating from 1.7651, it has decreased to 1.7386. So CHF is depreciating because CHF has a higher interest rate. With that, we have solved this question. That's all for today's video. In our next video, we would be discussing about forward rate parity condition. Thank you.